For nearly a century, the U.S. dollar was more than just a currency. It was a symbol of global stability, economic strength, and geopolitical dominance. Nations stored it as reserves, corporations used it for trade, and investors trusted it more than gold at times. But in 2024 to 2025, something changed. The world began to question whether the dollar's era of uncontested dominance was finally coming to an end. Inflation remained elevated. Interest rates fluctuated. America's debt surged. Global conflicts destabilized supply chains. And major global players, from BRICS nations to Middle Eastern allies, started planning a financial future that didn't depend on the U.S. dollar. This isn't just market noise. This is the beginning of a slow but historic shift in the world's financial power structure. Today, Finance Tales takes you inside that transformation, why confidence in the U.S. dollar is falling, what the rest of the world is doing about it, and how this change could reshape the global economy for decades. Warning Part 1. Why global confidence in the dollar is falling. 1. America's debt crisis, the number that terrifies economists for years. The U.S. national debt grew steadily. But between 2020 and 2025, something unprecedented happened. The U.S. added over $10 trillion in new debt, faster than any period in history. By 2025, the debt crossed $35 trillion. This matters because foreign governments buy U.S. treasuries to stabilize their reserves. Treasuries used to be considered the safest asset in the world. But when debt grows too large, confidence weakens. Foreign central banks, from China to Japan, started reducing their treasury purchases. Why? Because servicing that debt requires the U.S. to either print more money, borrow more, raise taxes, or risk default. Any of these paths weaken long-term confidence in the currency. 2. Money printing and inflation. Dollar supply explosion. When the U.S. printed trillions during the pandemic stimulus era, the dollar supply expanded at a historic rate. More dollars in circulation equals less value per dollar. From 1971 to today, the dollar has lost over 97% of its purchasing power compared to gold. In the last 3 years alone, rent increased, groceries increased, gas prices remained volatile, the cost of living rose in almost every category around the world. Countries holding U.S. dollars watched its buying power shrink, and they started questioning whether the dollar was truly safe. 3. Rate cuts, yield drops, and capital flight. In 2024 to 2025, the Federal Reserve signaled intentions to cut interest rates after a long period of historic highs. When U.S. interest rates drop, foreign investors earn less on U.S. bonds, yield becomes unattractive, money starts flowing to other countries offering better returns. This causes weaker dollar, higher market volatility, reduced foreign demand for U.S. debt. A currency's strength comes from demand, and demand has been weakening. 4. U.S. political instability and global perception. For global investors, trust in a currency is built on heavy checkmark political stability, heavy checkmark consistent policy, heavy checkmark predictable regulation, heavy checkmark strong institutions. But recent years have seen government shutdown threats, debt ceiling crises, hyperpartisan politics, unpredictable economic policies, trade wars, international sanctions. Global investors see risk, and risk reduces confidence. 5. De-dollarization. The biggest threat of all. For decades, the world depended on the U.S. dollar for everything, but today, major powers, including China, Russia, India, Saudi Arabia, Brazil, and many African nations, are seeking alternatives. This trend is called de-dollarization, and it includes heavy checkmark buying less U.S. debt, heavy checkmark using local currencies for oil trade, heavy checkmark increasing gold reserves, heavy checkmark creating regional payment networks, heavy checkmark developing BRICS currency systems. Saudi Arabia, a longtime U.S. ally, has recently accepted non-dollar payments for oil in multiple transactions. This is historic. Oil was the backbone of the dollar's dominance since the 1970s petrodollar agreement. If oil begins trading in multiple currencies, the world no longer needs U.S. dollars at the same scale. Global ripple effects. How the world reacts. 1. Foreign governments are dumping dollar assets for the first time in decades. China reduced its U.S. Treasury holdings. Japan slowed new purchases. The Middle East diversified. BRICS stockpiled gold. Foreign central banks are reducing exposure to the dollar because they fear long-term inflation. Geopolitical risks. Declining U.S. global influence. This slow withdrawal weakens the dollar further. 2. Gold is becoming the new old safe haven. For thousands of years, gold was the ultimate store of value. Suddenly, countries are buying gold at the fastest rate in modern history. Why? Because gold cannot be printed, cannot be frozen by sanctions, cannot be devalued by a government, holds value during economic distress. Central banks bought over 1,000 tons of gold in a single year, a record high. Gold demand equals dollar doubt. 3. Shifting global trade patterns. Countries are building alternatives to the U.S.-powered SWIFT system. China's CIPS, India's Unified Payments Interface expansion, BRICS payment systems, regional settlement networks. This reduces reliance on U.S. banking and U.S. currency. 4. Dollar sanctions weaponized. A backfire. When the U.S. sanctions nations, it freezes their bank accounts' dollar reserves, access to SWIFT, but this made other countries realize, if it can happen to them, it can happen to us. So they started reducing dollar dependence to avoid vulnerability. What it means for America and regular Americans. 1. Imports become more expensive. A weak dollar raises the cost of electronics, cars, clothes, raw materials, fuel. Because America imports more than it exports, consumers feel the pressure quickly. 2. Inflation stays sticky. Even if the Fed cuts rates or tries to cool inflation, a declining dollar keeps prices elevated. America could experience higher grocery prices, rising rent, more expensive healthcare, higher interest rates for longer. 3. U.S. global power declines. Dollar dominance gives America 3 major powers: economic power, easy borrowing; geopolitical power, sanctions; military power, global funding access. If the dollar weakens significantly, borrowing becomes harder, sanctions lose impact, global influence shrinks. 4. Investments change forever. Americans may shift toward gold, commodities, foreign stocks, real assets, cryptocurrency, hard assets like real estate. The traditional all-dollar portfolio becomes risky. Final conclusion: the U.S. dollar isn't collapsing tomorrow. It's not disappearing, and it's still the world's most used currency. But global confidence is changing, slowly, structurally, and permanently. For the first time in decades, the world is preparing for a future where the U.S. dollar is not the only anchor of global finance. And that shift, whether it unfolds over 5 years or 25, will reshape global markets, wealth, geopolitical power, and the lives of every American. The dollar crisis is not just about currency. It's about the balance of global power, and that balance is moving.